Hey everyone, welcome to CoveredCall ETF Investing. I'm Jordan, and this is your central hub for deep CoveredCall ETF data. And in today's video, we're going to be rounding out a mini-series where we are looking at funds that, specifically CoveredCall ETFs that are like certain indexes, like the S&P 500, and in this video, like the Nasdaq-100. So last week, it was the purity test of which funds could be the most like the S&P 500, and this week we're going to be grading funds that are most like the Nasdaq-100 based on 4 qualities. So we are looking at fund composition. So does the sector mix, is it the same as the Nasdaq-100? Does it own its underlying assets, which is important? We want to actually own these good businesses that are part of the S&P 500. Does it have growth potential? So these are CoveredCall ETFs that are under 50% coverage. That'll score a point for growth potential. And then lastly is distribution consistency. Many of you have reached out to me asking what funds are good for, what CoveredCall ETFs specifically are good for, distribution consistency and growth potential. And so those qualities I put in there just because I know many of you are concerned about that, right? Can some of these funds just naturally grow on their own while you extract the distributions and either live off of that or supplement various parts of your lifestyle? So let's get into ranking these by those qualities. So I'll just kind of randomly pick from wherever in the middle here, just to get a good idea. Now, I think what we're going to do is start with Defiance. Poor old Defiance. As I said last week with JEPY, it's no different with QQQY. And to be fair to this strategy, it's not really a CoveredCall ETF. It just isn't. But for educational purposes, I want it to be in here just to differentiate it from the ones that are actual CoveredCall ETFs. So in this case, QQQY, it doesn't actually own its underlying assets, so therefore its sector mix can't be close to the Nasdaq-100. Now, as I said with JEPY, it basically mimics the price performance of the index by using various derivative strategies. But for the purity test, because it doesn't own its underlying, it can't have the sector mix that we're looking for to grade it a little bit higher. And then its distributions, again, all over the place. I would give it points if its distributions were fairly stable. And its growth potential, it's very much an income-driven fund, which means it's not going to have the growth potential that we could maybe see from certain CoveredCall ETFs that have, say, less than 50% coverage on it. So for that reason, QQQY by Defiance scores the lowest mark. So FEPI scores a C. Why does FEPI score a C? Well, its distributions are actually fairly stable. It owns its own underlying assets. So for those reasons, it scores 2. Where it starts to kind of fall apart is it is a very much a pure technology fund. So its sector mix is not totally like the Nasdaq-100, and its growth potential. Now there might be an argument to put it into the B category, but it's with its growth potential. I suspect that its portfolio coverage is above 50%. That to achieve a 25% yield, it's got to be way higher than that. It has surprised during this last bull run. It is a victor of its inception date. It has done quite well on a price performance level. Maybe there's an argument you could put in here, but unfortunately, it's not clear on the prospectus what the portfolio coverage is, and because of that, I gotta unfortunately assume that it's just higher than 50%. So it gets a C. Next up on the list is, what are we gonna do? Let's go ZWT. So that's also a C. ZWT, its distributions are fairly consistent. It owns its underlying assets, but kind of like FEPI, it's highly concentrated in just technology alone. Plus, it also has 50% coverage on the portfolio. Now, ZWT, let's be clear, for the kind of fund that it is, being so concentrated, its growth has been really good. But again, this is a purity test. How much of it is actually like the Nasdaq-100? And for growth potential, let's also include HTA. So it's, again, just like FEPI, just like ZWT, technology focused. Its distributions are stable. The only thing that's holding it back is, well, actually, you know what? HTA has about 33% coverage on it. This thing I'm going to put into the A category. Where I struggled with ZWT, I'm gonna give HTA actually a B, just because it does have that 33% coverage. So very growth oriented. Its distributions are stable. It owns its underlying assets. The only thing that holds it back is the fact that it is so concentrated for this purity test. Okay, next up is HTAE, which is just the steroid version of HTA. It's got leverage. It has all the same characteristics as HTA, just it has 25% leverage. So an even higher growth component. And I actually own HTAE on a percentage-wise, it's doing the best in my portfolio, just on price appreciation alone. Let's give this a, let's throw in an A in there. So GPIC. So just like the last video, I gave GPICs an A. I'm giving GPIC an A. Why? Distributions, fairly stable. It owns its underlying assets. Its sector mix, fairly close to the Nasdaq-100. And it has the ability to grow with that 25% to 75% portfolio coverage. So in a not so great market, it probably leans much high to that higher coverage. Maybe in a bull market, it at least has the potential to grow with the smaller portfolio coverage. So for that reason, I give it an A. It just, for what we're trying to accomplish here in this grading this criteria, it kind of checks off most of all the boxes. Whereas these other funds, as you can kind of see, I'm kind of struggling. Like I do want to give some of these a higher grade, but again, the question is how much of it is actually like the Nasdaq-100, and some of these are just pure technology funds, which are great funds, but they don't have the same, say, sector mix as the Nasdaq-100. Okay, JEPQ, this one is a C. Its distributions are all over the place. Its growth potential is muted by the ELNs it invests in. There's about 20% in there. But its sector mix is fairly close to the S&P 500. There's about 100 plus funds, and it owns all of its underlying assets. Okay, so next up we'll do QYLD. QYLD, very similar to the Nasdaq-100. It owns its own assets, but it has 100% coverage at the money, and its distributions bounce around all over the place. So for that reason, it gets a C. Let's do QYLG. So QYLG is just the technical growth version of QYLD. Sector mix is fairly close to the Nasdaq-100. It owns its underlying assets, but what holds it back is distribution consistency and its growth potential. Now, QYLG, it's at about 50%. Now, that other 50% has done well for QYLG. Make no mistake about it. Can't stress it enough. Some of these funds have done amazing for just being at 50%, even with the Nasdaq-100. By the way, I'm recording this video at the same time as I'm doing the S&P 500. So if there's critiques from the S&P 500 video, I'm not going to catch it for this video because it's being basically filmed back to back. Okay, so QYLG is basically the same, 50% coverage, even though it's done well at 50%. What else do we got here? TXF. TXF is, what do I got here for TXF? It's a C fund. All right, so with TXF, what keeps it back from being a much higher fund is the fact that its distribution is all over the place. It pays out quarterly, and they bounce around quite a bit. Its sector mix is highly concentrated in pure technology, so it mimics a lot of other funds that we see in here. It has the ability to grow. It has about 25% coverage on it at the money, and it owns its underlying assets. So for that reason, it ends up being a C. Next up is TLF. We put it into the B category. So again, the only thing that's really holding TLF back is just it's much more pure technology driven, but it has the potential to grow. Distributions are stable. Basically, it checks off all the boxes except for that composition element to it. Next up is QQCC. This fund owns an underlying asset or an underlying ETF by Horizon. I forget which one it is. So with QQCC, it owns its underlying assets. Its distribution is stable. The sector mix is there. The only thing holding this one back from an A is just the 50% coverage. Not to say that it can't do well at that 50% mark, but that's what is keeping it from being an A. However, QQCL, just like QQCC, it just has that leverage component. It basically takes care of those small hesitancies that I have to give it an A. So QQCL gets the A because it does have that growth element with leverage. Next up is QQQI, and I got this one as a C. So the reason for this fund being where it is, distributions are, for what scores it at a C, its distributions are bounce around. It's a newer fund also, so it bounces around. Its sector mix is fairly close. It owns its own underlying assets. But yeah, distributions all over the place, and its growth potential, we have kind of yet to see what it can possibly do as far as growth is concerned there. And then lastly is QQQY. So QQQY by Evolve. So far, stable distributions. It owns its underlying. Its ability to grow is there with that 33% coverage. So you know what, with QQQY, I put it in the B category, but the reality is, with stable distributions, the ability to grow, it owns its underlying, and you know what? I believe sector mix fairly close to the Nasdaq-100, so I'll give that one an A. So there you have it. We have now graded all the Nasdaq-100 funds. Let me know in the comments below what you think, and I will see you all in the next video.